Everyone loves free money, especially when the government is footing the bill. 2020 onwards, governments across the world have extended stimulus packages worth trillions of dollars for two reasons: to help citizens brave the pandemic and prevent the collapse of the global economy. Well, that worked. 2 years since then, a global recession had been averted. By 2021 end, leading stock market indices around the world had been peaking at 2.5 to 3 times values of their 2020 lows. The stimulus packages complemented by the cheap access to funds has helped investors borrow money at near zero rates and invest heavily in promising companies, especially those in the tech industry that are now sitting at lofty trillion-dollar valuations. Some of these without ever having turned a profit. However, the buck must stop somewhere, and from the looks of it, it finally has. While this cushioned the blow of the unexpected lockdown and offset the impact of plunging customer spending, economic stagnation, and millions of lost jobs, global debt grew to nearly $20 trillion in 2020 alone. The debt on the balance sheet for the US Federal Reserve has more than doubled from $4.1 trillion in March 2020 to $8.6 trillion now. What's even more alarming is that inflation in the US has touched 7.5%, a figure last seen in 1982. Similarly, in India, the CPI inflation has been recorded at 5.59% in December 2021, a number that is likely to make the RBI very uncomfortable. Hold up! How does inflation lead to an interest rate hike? When a central bank slashes interest rates, it does so to increase the supply of money in the economy by making the cost of acquiring money cheap and accessible, and drives up the money being spent in an economy. For example, if borrowing costs go down, the EMI on car loans go down, increasing demand. On the flip side, availability of cars is finite in the short term and cannot keep up with the demand, which has happened 2020 onwards due to pandemic-driven supply chain disruptions causing a rise in prices. This can be observed across industries. Lower interest rates mean increased supply of money, increased demand of products, and increased inflation. So when the Fed hikes interest rates, how does it affect India? Increasing interest rates is an important ploy in the Fed's toolkit to counter inflation. It hikes the short-term borrowing rate for commercial banks, who in turn increase the cost of retail lending to customers like us. The Fed has maintained interest rates at near zero levels since 2019. Now it plans to hike interest rates in the range of 0.6 to 0.9% in 2022 and 1.4 to 1.9% in 2023. This rate influences everything from interest on credit cards to mortgages and car loans, making borrowing more expensive for consumers in the US. This cascades into a significant domino effect, deeply impacting Indian markets. Here's a history of Fed rate hikes and the corresponding effect on India. If you look at this graph closely, you will see a pattern of stock market movements in the S&P 500 after interest rate announcements. Typically, the American stock indices soar as soon as the interest rate cut is announced, sometimes reversed immediately in the following days. These reactions are generally mirrored across developing markets such as India. Here's a look at some changes that we might see. Sell-off of Indian investments by global investors. Marquee foreign institutional and portfolio investors in the US borrow money at zero or near zero interest rates and reinvest the money in Indian stocks and bonds. Nifty 50 grew by a whopping 23.79% in 2021, making the case for investments in the country very, very attractive. An interest rate hike leads to a flight of capital from debt and equity markets in developing economies. As borrowing becomes more expensive for US investors, their ROI from investments in global assets becomes less lucrative, especially with respect to the intrinsic risk in these markets, causing a global sell-off. Copycat reactions by other central banks. Where the Fed goes, others follow. Jerome Powell and his seat at the Federal Reserve exerts significant influence on other central banks and financial institutions across the world. A hike in the interest rates in the US could further be emulated by the European Central Bank or the Bank of Japan, which would further move foreign capital back into home countries, leading to a severe crash in asset prices in developing markets. Higher interest rates and lower liquidity in India. Closer home, the RBI may decide to increase interest rates to keep Indian government bonds competitive and prevent a global sell-off of our securities. RBI may choose to increase the interest rate, which will in turn increase borrowing costs in India, hamper liquidity, and derail foreign investments. Depreciation of the rupee. As the Fed hike comes into effect and money flows into the US markets, the American economy becomes a more bankable state, which results in an increase in the value of the US dollar. As the USD becomes more expensive, the Indian rupee will further decline since global investors would continue to pull money out of Indian markets and into American ones. Safe havens such as gold and US Treasury investments will see more buying, which will eventually lead to a liquidity crunch in India that can hamper investments and growth. Now, in 2022, this would probably mean a tragic end to overvalued businesses, oversubscribed IPOs, and liquidity-fueled market rallies, which has already dipped in the first quarter. However, in the long run, it can bring down inflation and normalize asset pricing across equity and debt markets, until, of course, it's time for the economic cycle to repeat itself. But until all these moving parts come together, the liquidity party continues with a few stops and pauses in between.